Hey Bowtie Nation, Joseph Hogue here, and nowhere was the stock crash worse last year than internet retail stocks. In a report by Yardeni Research, we see stocks in the consumer discretionary sector fell 37% as Wall Street feared a consumer spending nightmare in a recession. And within that consumer sector, internet retail stocks took the worst of it, crumbling by 48% just in the last 12 months. But for all you Warren Buffett fans out there, you know that could be the best time to buy. That peak fear in the markets for these stocks. Buying when there is blood in the streets. I have found 5 stocks to watch in 2023 that may have reached that peak fear and are ready for a rebound. First up is the RVOL Group, ticker RVLV, an online fashion retailer through the Revolve and Forward marketplaces. Growth is still here, with the company reporting a 34% increase in active customers to 2.2 million in the third quarter, and analysts are expecting sales growth of 21% this year. Now, that could slow to 7% next year, but Revolve has a very strong position within that Gen Z and the millennial markets and will continue to grow as those groups build on their purchasing power. Revolve's lower marketing costs and higher margins come from an influencer marketing strategy that helps it boost its brand strength online. A new loyalty program for the Forward brand should also help drive those sales along with an international expansion. Besides that growth, what I really like here is Revolve is already cash flow positive. That's something we're going to talk about later. But the company has $218 million in cash on the balance sheet. That's against just $3.1 million owed in long-term debt, giving the company years of survivability and financial flexibility. Finally, the shares trade for just 1.6 times on a price-to-sales basis. This is a stock still growing sales by double digits a year, firmly in that growth stock territory that as recently as last year traded for 4 times on a price-to-sales basis, now trading for less than half that valuation, but still the same long-term growth outlook. I'll be using the screener on StockCard to find these stocks, and I'm going to walk you through how I did that later. Besides a great site for researching stocks, you can also create and follow portfolios on the app. If you do sign up for StockCard, don't forget to use the promo code BowtieNation, that's all one word and lowercase, for an exclusive discount beyond the free trial. CHWI, ticker CHWI, has been able to dominate the online pet foods and medications market in a very short time. Founded in 2011, the company uses a subscription-driven model that makes for very strong loyalty and recurring revenue. Nearly 3/4, about 73% of the customers are on an auto-ship service and billing. And Morningstar estimates the online pet foods market around $35.7 billion, which means in just a little over a decade, CHWI has grown to over 28% of its market, a very strong advantage in what's a fragmented market. Considering online penetration in this industry is only about 30%, so of that $119 billion total pet food and meds market, only 30% is online. That means years of growth is still out there for this company. The company is generating positive cash flow from operations, though it's still heavily investing in growth, so that free cash flow remains negative. It's not a worry though, with over $800 million in balance sheet cash against just $410 million owed in long-term debt. So this is another one here that is net cash positive for all the financial survivability it needs. Sales are expected to grow 12.9% this year, though to slow a little to 11% next year. I really like the consumer staples feel of this stock. You know, pet owners aren't going to cut back that much on their pet food or the medication, even in a recession, so you've got great cash flow stability with this stock. Now, CHWI just started trading in 2019 and was one of those pandemic darlings that shot up as pet ownership increased during the lockdowns. It's now trading for just 1.7 times on that price-to-sales basis. Again, less than half the 2020 valuation, with a long runway of growth ahead. We'll get right back to our list of stocks to buy, but I want to get you started with how I found these. So just a quick walkthrough here, and later I'm going to show you what I'm looking for in each of these rebound stocks. If we go to Tools and then the stock screener here, we can screen for stocks or ETFs, a great feature whether you're looking for stocks or funds. Then, one of my favorite features here is you can narrow your list of stocks down by themes, industry, or other keywords. So if I type in internet here, the dropdown is going to suggest all these themes in internet stocks, including content, software, and here we have internet retail. From there, you can browse through this screener, and I'm going to select only those companies with a market cap of at least $300 million or more. Then I'll also scroll down and narrow it to those with good cash availability and click apply. That still leaves us with over 10 stocks to research, but you can play around with these filters to see more or fewer stocks. eBay, ticker EBAY, is the slowest growing e-commerce stock in this list, but hard to ignore that scale of $74 billion in merchandise volume and $10 billion in revenue. Now, sales are expected down 6% this year and just flat next year, but everything else says watch this stock in 2023. The company generates $2.2 billion in free cash flow a year and has over $7.3 billion in cash on the balance sheet. Now, long-term debt is a little higher at $6.5 billion, but eBay doesn't quite need that cash cushion that you would want into those smaller, newer companies. The company is on track to its goal of doubling ad revenue by 2025 and seeing strong growth in those trading card segment. What I really like about eBay here is that it's adopting that Amazon and Google model of early stage investments. Basically here, you're buying the main business, but getting these startup investments as kind of a lottery ticket play. If any of these really take off, the company could really benefit. Shares are down to 2.3 times on that price to sales basis, which is about a 33% discount to the 5-year average. For a lower growth stock on the list, I would like to see it down closer to maybe 2 times sales, but it's definitely in that range where you can comfortably buy this on that long-term rebound potential. We've still got 2 more of our 2023 stocks to watch, including one that was up 319% since recommending it in 2019, only to crash 97% since then. But all you out there in the nation know, I'm not just about to drop a list of stocks in your lap and say, here, go buy these. I want to show you what I'm looking for in these rebound candidates so you can pick your own stocks, so you become a better investor. First, because of how harsh the sell-off was last year, how far these stocks have fallen, and the fact that a recession will probably only make matters worse, I'm first looking here for measures of survivability. So first, I'm going to look at the statement of cash flows to find the companies that, while earnings might be negative, are still creating that positive cash flow at the operational level. We don't need to go too deep into the financial statement analysis here, but just know that the income statement and that earnings per share that you see all the time, it's not the first place you should be looking at these beaten down stocks. You want to make sure that a company is producing legitimate cash flow from its operations. For example, even though CHWI reports a loss on the income statement, if we look at the actual cash in and out of the company here, it's still generating positive cash flows, which means more for its survivability. Next, I go straight to the balance sheet and look for how much cash and long-term debt the company has on its books. Because even a company with negative cash flow can survive if it has enough cash set aside or isn't burdened by too much debt. It can keep those operations going until the economy improves, or it can borrow to fund the business. That balance sheet health just gives it more flexibility here. For example, even though the Revolve Group has been cash flow negative in operations for 2 of the last 4 quarters and burned through some balance sheet cash, it has a mountain of $255 million in cash against debt of just $3.5 million. That cash can be used for growth acquisitions, investments, R&D, basically anything the company needs to keep growing. And once we've found those companies we know will survive, we also want to narrow down that list to the best of the breed stocks. For that, I'm going to be looking for sales growth above competitors and preferably still in that growth stage of 10% plus. It is still going to be a tough economy for retailers in 2023, and even for these stocks, the average sales growth is only expected to be about 6 or 7% growth from last year. If we can find those retailers, though, with a competitive advantage in distribution or scale, those are the companies that are going to take that market share from competitors and have the best shot at rebounding when the economy improves. And finally, I don't care how great a company is, paying too much for a stock can still mean losing money. For example, Cisco Systems would go on to dominate the enterprise tech services for more than a decade, but if you bought at that 2000 peak, you would still be losing money. So here, I'm looking for that price to sales ratio, looking for stocks selling at attractive valuations versus their own history, as well as the other stocks in the industry. You cannot talk e-commerce without talking about Amazon, ticker AMZN, and the leader in this space is finally at an attractive valuation. Amazon dominates its 2 core markets with nearly 60% of the US e-commerce market, a number no other company can even come close to matching. Amazon also controls 1/3 of the global market for cloud services, 50% more than its next largest competitor. And when you've got that kind of market control, it's just an advantage the company is going to be able to use across all its products and services. Revenue has doubled in the last 3 years to $500 billion and is expected to hit nearly $600 billion this year. So even if it's not that growth stock pace that we saw last decade, this is still a very respectable 10% plus pace in growth. Amazon is cash flow positive here and over $95 billion in cash on the balance sheet. Even more surprising though is it's net cash positive with only $59 billion in long-term debt. That's $36 billion in balance sheet cash. And I really do think the market is underestimating shares of Amazon. For a share of Amazon, basically you're paying for that valuation on the core e-commerce platform, Amazon Cloud Service, and Prime, but you're also getting all those other investments, the Alexa venture investments in AI, voice, and those other tech innovations. But I have always had trouble recommending Amazon because of the expensive valuation, but after this most recent sell-off, it's now down to a place I've never seen it before. Shares trade for just 1.7 times on that price to sales basis, which is less than half the 2020 valuation. I'll reveal that last stock to buy next, but I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, by far the riskiest stock in our list, but potentially the highest upside, is SFIX, ticker SFIX. Now, you longtime citizens of the Bowtie Nation out there are going to remember I recommended SFIX back in 2019 around $22 a share, just before the price rocketed up to $95 each by 2021. Now, since then, the stock has crashed with the rest of the e-commerce market last year, but I'm taking another look here. The company is an online fashion service that touches a lot of the disruptive ideas beyond e-commerce, including data analytics and AI. It's using a data-driven algorithms and human intuition to help match people with their perfect look. Customers create a profile that assesses their preferences and then matches them with a stylist, then powers that retail service with delivering a product. All this means is that even on a 21% drop in revenue reported in the first quarter, it was able to make more on a revenue per client basis because the more a customer uses the app, the more their experience improves. Now, that drop in revenue and the fact that the company is burning $15 million of cash a year on that negative cash flow is something to worry about. But SFIX also has $204 million in balance sheet cash against just $147 million in long-term debt. Sales growth is expected to turn positive this year, and the shares are trading for a rock bottom price of just 0.2 times revenue. At that valuation, if shares don't jump over the next year, I expect the company is going to get an acquisition offer from a larger retailer. Basically, any traditional apparel retailer would kill to have that kind of a data-driven platform and the AI used by SFIX, and it may only be a matter of time. Check out that stock screener on Stock Card with the link below, or click on the video to the right for the one blue chip stock every investor should own, my favorite bellwether stock. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.